Hello everyone, welcome back to our channel. The world stage is currently witnessing a whirlwind of significant events, reshaping global dynamics in profound ways. Today, we delve into a series of interconnected developments involving major economic powers, technological shifts, and strategic geopolitical maneuvers. We'll explore how specific actions by China are sending shockwaves through key industries, impacting global supply chains, and potentially altering the economic landscape for nations worldwide, particularly the United States. From the semiconductor sector to aviation and beyond, the consequences are unfolding rapidly, raising critical questions about economic stability, technological independence, and the future balance of power. We encourage you to subscribe to our channel and hit the like button if you find this analysis insightful. Your support is crucial for helping us bring you these updates. Also, let us know in the comments where you're tuning in from. We love hearing from our global audience. What precise action did China take that resulted in Intel forfeiting $100 billion in a mere 48 hours? On April 12, 2025, a pivotal moment occurred when China initiated measures that led Intel to lose this staggering sum within just 2 days. Intel's stock experienced a sharp decline, plummeting by 18.3%. This downturn significantly impacted the company's financial health, affecting 27% of Intel's total revenue, which equates to roughly $22 billion based on 2024 figures. This highlights Intel's considerable vulnerability due to its reliance on the Chinese market. How will this seismic event reshape the technology industry? It wasn't just Intel feeling the pressure, the entire tech sector felt the reverberations. China dealt a significant blow to Intel. The directive issued on April 12, 2025, prohibited Chinese government agencies and major state-owned enterprises from acquiring computer chips manufactured by key U.S. companies, including Intel, Advanced Micro Devices, AMD, and Micron Technology. This wasn't an isolated or random occurrence. It represented a meticulously calculated strategic maneuver. The immediate aftermath saw Intel's market capitalization shrink by $100 billion in only 48 hours. Its stock value dropped dramatically by 18.3%, a clear indicator of the market's reaction to losing access to a significant portion of its customer base. The Chinese market accounts for 27% of Intel's revenue, translating to $22 billion in 2024 alone. This dependency made Intel an accessible target for a potent strategic move by China. This development sent ripples across the tech landscape, raising serious questions about supply chain stability and the future of global technology trade. We urge you to watch this video until the end, as we will be drawing important conclusions from these interconnected events. So, what unfolded next? The repercussions extended beyond Intel. Intel's stock plunge dragged down broader semiconductor indices. The SOXX and SMH exchange-traded funds, which track the performance of semiconductor companies, fell by 4.2% and 2% respectively. This demonstrates that Intel's heavy reliance on the Chinese market created a vulnerability not just for the company itself, but for the entire U.S. tech industry. When China targeted this dependency, the whole sector faced significant difficulties. These impacts, however, are not confined solely to Intel. They extend to other technology firms, raising widespread concerns about the instability of the global supply chain. This incident underscores the critical need for diversification within the U.S. semiconductor industry. If American tech companies do not rapidly diversify their markets and supply chains, they could face a prolonged period of crisis, struggling to regain footing in an increasingly complex and competitive global arena. China's ambition is to reshape the global technology landscape. Beijing hasn't merely severed ties with Intel. The nation has established a clear objective to eliminate U.S. manufactured chips from its public sector infrastructure and energy systems entirely by the year 2027. Experts forecast that this strategic push could erase up to $350 billion in revenue from U.S. chip manufacturers by that deadline. Achieving complete technological independence is undoubtedly a challenging endeavor. Nevertheless, China's strategy is advancing rapidly. This progress is fueled by substantial national efforts to cultivate domestic chip technology. A prime example is Huawei, which has successfully produced 5-nanometer chips and even reportedly 7-nanometer chips for devices like the Mate 60 Pro smartphone, without relying on advanced extreme ultraviolet (EUV) lithography technology, something the U.S. previously deemed nearly impossible without access to specialized equipment, often restricted by sanctions. This capability proves that China can independently manufacture sophisticated chips, bypassing the need for American assistance or technology. This development poses the most significant challenge yet to U.S. technological supremacy. How could this fundamentally alter the competitive dynamics? If Huawei can achieve this level of sophistication with smartphone chips, can it replicate this success with processors for servers, cloud computing infrastructure, or artificial intelligence applications? This is the critical question preoccupying technology experts globally. With the demonstrated ability to produce advanced chips independently, Huawei is not just competing directly with established giants like Intel, but is also influencing the global pricing and availability of high-technology products. The implications are vast, potentially leading to a major realignment in the global tech industry. If China continues its strong development trajectory in this field, consumers worldwide might witness a significant market shift, with Chinese tech products becoming increasingly prevalent and competitively priced, thereby threatening the long-standing dominance of U.S. tech corporations. China's actions extend beyond Intel, impacting other key players in supply chains. The nation has also cut ties with ASML, the Dutch company crucial for semiconductor manufacturing equipment, particularly lithography machines, and TSMC, the world's largest contract chip manufacturer based in Taiwan. Is the Western chip industry facing an imminent collapse? China's moves certainly signal a major disruption. The country shocked the global community by halting cooperation with both ASML and TSMC. This wasn't a sudden decision, but part of a larger calculated strategy. Between 2022 and 2024, China invested a massive $75 billion into its domestic semiconductor industry, attracting over 50,000 engineers to bolster its capabilities. Concurrently, China retaliated against U.S. trade pressures by imposing a staggering 84% tariff on certain U.S. goods. This geopolitical chess game escalated when, in 2025, the Netherlands, reportedly under pressure from the United States, halted the supply of critical deep ultraviolet (DUV) lithography machines to China within 72 hours of a U.S. request. In response, China decided to completely sever all ties with ASML and TSMC. This decisive action is not merely a temporary policy adjustment, but a long-term strategic pivot for China, aiming to gain full control over its semiconductor future and reduce dependence on foreign technology. The severing of these strategic ties is a strong reaction to perceived pressure from the U.S. and its allies, indicating China's resolve to build a fully independent chip ecosystem, regardless of the global economic fallout. This move has sent shockwaves through the global economy, intensifying concerns about escalating tensions in international economic relations and the stability of technology supply chains. The consequences of these strategic shifts are already being felt by American consumers. Major U.S. computer manufacturers like Hewlett-Packard, HP, and Dell have announced price increases ranging from 12% to 17% for computers equipped with Intel chips. These price hikes are partly a response to the supply chain disruptions and the increased costs associated with navigating the complex geopolitical landscape. The interruptions in the supply chain, particularly concerning essential components like semiconductors and rare earth minerals, will inevitably drive up the prices of electronic products across the board. This directly impacts consumers, who will find themselves paying more for the goods they rely on daily. It's not just computers. Other electronic devices such as smartphones, servers, and various high-tech products are expected to see similar price increases. This reality means the cost of living for American citizens is becoming more burdensome. Households are already grappling with inflation, and these added costs further strain budgets. Consumers will have to allocate more money for products they are accustomed to purchasing, potentially forcing difficult choices between essential goods and discretionary spending. China's strategy isn't limited to semiconductors. It encompasses a broader financial approach. The nation is actively working to influence global financial markets and reduce its reliance on the US dollar. One of the key strategies involves building an independent technology ecosystem completely free from Western dependency. Severing ties with major Western tech suppliers like ASML and TSMC is a significant step in this long-term plan. China aims to dominate the global semiconductor industry and minimize its exposure to external pressures or sanctions. Furthermore, China is responding directly to sanctions imposed by the US and Western nations. From the moment these sanctions were implemented, China didn't just cope, it accelerated the development of its domestic industries and retaliated strongly. The imposition of an 84% tariff on US exports in 2025 was a direct countermeasure to previous US tariffs. This tit-for-tat escalation sends clear shockwaves through the global economy, highlighting the increasing tension in international economic relations. These actions demonstrate that China is not merely reacting, but proactively shaping its economic future, seeking to establish a new global order where it holds greater influence and control. Responding to sanctions and trade pressures, China has not just been developing alternative technologies, but also strategically adjusting its financial position. From the moment the US and Western countries imposed sanctions, China accelerated the development of its domestic semiconductor industry. Between 2022 and 2024, China invested over $75 billion in research and development, attracting over 50,000 engineers from leading companies like Huawei to join its chip research workforce. What's most notable is China's strong retaliation against sanctions. In 2025, China imposed an 84% tariff on US exports, a direct countermeasure to previous US tariffs. This action, combined with the halting of cooperation with ASML and TSMC, following the Dutch restriction on DUV lithography machines, demonstrates a clear long-term strategy. China aims not only to achieve self-sufficiency in critical technologies, but also to build a fully independent chip ecosystem, controlling its future in the semiconductor industry. This strategic response shows China is not just coping with sanctions, but is actively pushing back and reshaping the global tech landscape to its advantage. China's goal extends beyond self-supplying semiconductors. It aims to establish a fully independent technology ecosystem, completely free from Western dependency. Severing ties with ASML and TSMC is a crucial part of this long-term strategy to dominate the global semiconductor industry and reduce reliance on major Western companies. This shift is not just about responding to sanctions, but about proactively building a new technological and financial order. China has been developing alternative technologies, exemplified by Huawei's launch of the Mate 60 Pro smartphone featuring a 7-nanometer chip produced without ASML's banned EUV technology. This demonstrates China's potential to develop superior technology independently. Moreover, China is developing its own lithography technology to replace EUV, aiming to confidently produce ultra-small chips without relying on expensive Western technologies. This technological leap, combined with significant investments and a growing skilled workforce, shows China is not just catching up, but is positioning itself to lead in the chip industry, further solidifying its technological independence and challenging Western dominance. The US economy is facing a multifaceted crisis. The withdrawal of Chinese investment represents a significant shock. From a peak of $46 billion in 2016, Chinese investment in the US plummeted to just $2.3 billion in 2024. Now, with China completely freezing these investments, that figure approaches zero. This isn't a random shift. It's a calculated strategic move. Why has China decided to cut off this capital flow entirely? The answer lies in China's long-term strategy to reduce dependence on the US financial system and redirect capital towards regions deemed more politically and economically beneficial. This sudden withdrawal creates an investment drought in the US. Simultaneously, US businesses are grappling with a financial nightmare exacerbated by high interest rates. To survive, companies like Hartwell Tech, which lost $180 million overnight, have resorted to emergency loans with interest rates as high as 11.3%, nearly double the typical rate. This precarious situation pushes companies towards potential bankruptcy, especially if these conditions persist. High interest rates are not just a problem for large corporations, they directly impact American consumers, increasing borrowing costs and contributing to inflation, which remains stubbornly high at 3.6%. This confluence of factors, capital flight, investment drought, high interest rates, and corporate strain, paints a grim picture. It translates into a decline in the quality of life for many Americans. Wages remain stagnant while the prices of essential goods and services continue to rise. People face higher costs for everything from cars, with new car prices exceeding $50,000 and used cars jumping to $32,000, to basic services like oil changes, which have doubled in price due to higher parts costs. This financial pressure is intensified by tariffs on imported goods. The U.S. economy is also confronting a looming debt wall, with $4.1 trillion in business debt set to mature by 2026. In the context of foreign capital pulling out, U.S. companies are increasingly relying on high-yield junk bonds, with yields reaching 9.6%, double the rate in 2022. This indicates a growing risk of a debt crisis. The situation is further complicated by job losses. The U.S. auto industry, for instance, lost 200,000 jobs in just 3 weeks due to these economic pressures. Workers in manufacturing plants, technicians, and truck drivers face unemployment, creating a significant social and economic crisis, particularly in auto-producing regions like Michigan, Ohio, and Kentucky. These interconnected issues highlight the fragility of the U.S. economy and the profound impact of shifting global dynamics. Conclusions. The events analyzed today illustrate a complex interplay of geopolitical strategy, technological competition, and economic repercussions. China's calculated moves, from restricting chip purchases and cutting ties with key tech suppliers like Intel, ASML, and TSMC, to halting Boeing deliveries and imposing significant tariffs, represent a decisive push towards technological independence and a challenge to U.S. economic dominance. These actions have triggered immediate and substantial financial losses for major U.S. corporations like Intel and Boeing, exposing their vulnerability due to heavy reliance on the Chinese market. The ripple effects extend throughout the U.S. tech and aviation sectors, impacting supply chains involving thousands of companies and threatening significant job losses. Furthermore, China's ban on rare earth exports and its broader financial strategy, including reducing U.S. Treasury holdings, freezing investments in the U.S., and promoting the yuan in international trade, signal a long-term goal to reshape the global economic order and diminish the role of the U.S. dollar. These shifts are creating significant economic headwinds for the United States, characterized by capital flight, an investment drought, rising interest rates, corporate financial strain, potential bankruptcies, and increased cost of living for American consumers. The combination of supply chain disruptions, retaliatory tariffs, and strategic financial maneuvering by China presents a formidable challenge to the U.S. economy's stability and its position on the international stage. The coming years will be critical in determining how the U.S. adapts to this evolving landscape and whether it can maintain its economic strength amidst these growing pressures.